Dear students, welcome back to our lecture number 5 for chapter number 8. As I said before, it is a very long chapter. We last time covered up to slide number 48. So today we'll continue with next slide, which is a new topic, which is a future cost for business decisions. Now, what is a future cost? Right, this is related to our theory. Right, this is a very important concept in chapter number 8. This is in your book as well, given on page number, let me find out. Okay, these concepts are on page number 433. Right, these are important concepts which we need to familiar ourselves, especially when we are going to make a decision about whether to make or buy decisions. Right, now, in order to understand make or buy, or sometimes we call it or outsourcing decisions, right, for example, right, whether we should outsource some function that we are currently doing it by ourselves, or make or buy decisions. Basically, in this one we have to understand an important concept which we call it opportunity cost, right, or some costs which are important for futures. They are differential cost, opportunity cost, and sunk cost. We look at them one by one. First one is the differential, or we call it incremental cost. Right. Now, incremental cost this is what we call it, the cost that represents a difference in total cost. If we select one alternative instead of another, what will happen? So basically, we have to see how a cost behaves, whether if we increase or decrease with an overall change, right, by for example, if we increase or decrease one additional unit of a product, how cost will behave, what will be the changes in the cost. This is what we call it differential cost. For example, I can give you a simple example. Like in the class, we have a capacity of 30 students. For example, the maximum is 30 or even 40 or 50, whatever amount. That, let's say we are at that peak capacity, and now the requirement is to have one more student. Right. Out of, let's say, 40 is the maximum limit or the space available or the maximum capacity. If you want to add one more unit or one more student, then this class is not enough, or the space is not enough, or the resources is not enough. Right. In that case, what is the change in the cost? Do we have to rent a new room? Right. Similarly, in production environment, incremental cost, let's say we are operating at our full capacity, and if we increase one more additional unit, or there is a requirement from a customer that there is a one more additional unit, we cannot meet it unless we purchase new machines or we build a new plant, right, or whatever extra cost. So in that case, we should accept those kind of orders only when their differential cost should be less than the differential revenue, or we call it marginal revenue. We'll see it later on. Next important concept is the opportunity cost, which is a potential benefit that is given up as you seek an alternative course of action. Now, this is an example that opportunity cost when you decide to continue your college degree, right? So basically what you are saying is you are basically you are sacrificing your 4 years potential earnings, which you could earn by working somewhere instead of attending a college. Or I can give you another example. Instead of using our own warehouse for storage, we could, let's say, rent it to someone, right? So now that is, what is the opportunity cost here? If we don't rent our warehouse, right, we will lose the rent revenue which we could have earned by renting it out to someone. So this is an opportunity cost. These we may not see in our financial statements, these type of costs, but these are important for decision making. Remember, this is all about making decisions. Sunk cost is another type of cost, right? A cost that has already been incurred by the past decisions and it's not relevant for decisions. Example is let's say you change a brake last year, they are not relevant for making a sales decision in the future. That when you want to sell your car, it is not an important decision that you have changed your brake pads, right, for your cars. Now this is what we call it a sunk cost. Cost that has been incurred in the past, you cannot recover that cost. So I'll explain these concepts more when we solve some questions later on, right? Why these costs are important in decision making. Marginal cost is also same thing like what we have looked at before. Sometimes we call it differential cost or marginal costs, right? That if we what is the cost of if we increase the output just by a single unit, right? This is a typical example of a marginal cost when we pay our electricity bill, that if we consume first 1500 kilowatt hours, this is the bill, but for next 1250 the rate is different. If you increase to more than that, when it is next 3000 units, the rate is different, and above this rate it is different. So this is an example of a marginal cost or a differential cost. Example 8.6, this is what I will explain to you now, to explain what do we mean by those concepts what we have seen before. This example 8.6 is on page number 434 in our book. Benson Company is a farm equipment manufacturer and currently produces 20,000 units, right? This is what they are using, and expected production cost is given. Material, labor, power and utilities, these are all variable costs. It's given in a question. Material, labor and power and utility costs. These costs is based on 20,000 units. Fixed costs, heating and light and depreciation. This is a fixed cost. Okay, so this is fixed, these are the variable cost. Now Tompkins Company has offered to sell, so there is another company, right? They say, okay, we'll sell 20,000 of gas filters. Currently they are producing these gas filters by their own. So now they receive an order from this company. Okay, we will give you, or we will sell these gas filters at $17 per unit. Now this is their offer. If Benson accepts the offer, so the currently used manufacturing facilities, they could rent it to a third party at an annual rent of $35,000. Should Benson accept this offer or not, right? So this is what we call it. It's an outsourcing decision. Example of an outsourcing decision. This outsourcing decision, now in this example, yes, now if we have to purchase from this company, we'll pay this much amount, right? Now see, a simple concept. First what we will do is we'll see what is our per unit cost, right? What is our per unit cost? Okay, and we compare it with the price. If our cost is more than this price, right, then we should purchase from them. If our price is our cost, these are our cost. If our cost is less than this we should not purchase, of course. Now how to make a decision? Now maybe we can just add them. 445 divided by 25,000. Let's say if I do it like this one, see, if I use 445,000 divided by 20,000, so it's the total cost divided by the number of units we produce is 22.25. If we just look at this way, you may say, okay, so 17 is they are giving us at 17, so and this is our cost, so it's better to buy from outside. This is the immediate reaction if we look at these numbers, right? Now this was the reason that we studied those costs, those marginal costs or opportunity costs as well. See what is their impact in decision making. That's what we have to see now. If we simply say 22.25 and compare with this, no, but we have some additional information. Now what is the additional information here? If Benson accept this offer, right, what they can do is they can stop production of these gas filters and give that place to someone for a rent of 35,000, right? Now if we make it by ourselves, we will not get this rent, remember. Now this is an important concept, right? This is what we call it opportunity cost. We will lose this rent if we continue to make this by ourselves, right? But if we go for outsourcing and we purchase from them, then we can make this much, right? So now this is an important information which we need to consider in decision making. Let's see how our numbers will change. We'll see now. Okay, so this is the information which we had a given information, but if we continue to make this product by ourselves, we'll see here this number has been added now into a fixed cost, rental income lost, right? Now, why? This is also a cost, because if we continue to make this item, we will lose this 35,000. This is also a cost. So now if you want to calculate our cost, so it is 480 divided by 20,000, so it is a per unit cost is 24. Now this is a cost if we continue to make it by our own. So what we have done here, we have added one more cost here. Okay, this was an opportunity cost. Why we added it? I'll repeat it again. This is the cost or the revenue which we will lost if we make it. Remember, you cannot rent out. If you make these parts by yourself, that production facility, you cannot rent it out. If you cannot rent it out, means you lose this 35,000. So this is another cost. This is what we call it an opportunity cost. So now the scenario has changed. See, now our per unit cost is 24. Okay, right? If we continue to make, okay, not 22, what we calculated before, right? So let's see. Now if we outsource it, means when we buy it from the supplier, we will, of course, these are variable costs. We will not be using material, we will not be using labor, because these are variable costs. They depends on the number of units we are producing. If you don't produce anything, right, this was the opportunity cost. And if we buy it from outside, so if we don't produce, no material, of course, we are not using a labor, nothing. This variable cost is zero because we are no more making. What is the cost? We are paying this one, gas filter, which is 20,000. How we get this one? 20,000 multiplied by 17, right? Where is my calculator? Yes, see, it was 17 was the price times 20,000 units, so it was 340,000. So yes, so 340,000 is our cost 1. This is what we will pay, but fixed cost will be paying. Remember, this 20,000, whether you produce or not, you have to pay. Depreciation, whether so. Now, what is your costs now? This is the cost which you pay to Temkins, the other company, plus the fixed cost, right? So the cost is 460,000. And what is the per unit cost now? 23. Now with this analysis, now you see, this is very important, right? Now in order to make a decision whether to make it or to buy it, you have to compare a cost. If you make it, it's cost us 24. If you buy it, it cost us 23. So what is the better choice? Of course we should buy because it cost us less, or you can see here in the next column the difference into, right? So difference is this is the same thing, this minus this 100 minus 0, this the same, and this one 0 minus this, and there is no difference here. This one we have a loss in rental income, so if you add all of them, so it is 20,000 is the total differential cost, and 20,000 is the differential cost. 20,000 divided by 20,000, or 24 minus 23 is 1. You can just calculate the difference between these two. 480 minus 460 is 20. This is just a differential cost. So basically, if we buy it, it costs us $1 less. This is what we are going to save from this one. So it is better to buy this one, right? So you can so the buy option basically has a lower unit cost, right? And it saves $1 each, right, for a gas filter. Okay. Now this is the reason that we need to consider opportunity cost. If we did not consider this one, our answer could have been different. Our decision could have been a different decisions if we did not consider this opportunity cost. Okay, now we will move to exercise on 8.3. This is a short case study on page number 454. The Ace Bicycle Company produces bicycle. This year's expected production is 10,000 units. Currently also makes the chains for its bicycles. Ace accountant reports the following cost for making 10,000 chains as given. Now understand this one. Now this bicycle company, they produce bicycles, right? And they are going to produce 10,000 units. Also one of the component in bicycle is those chains, right? Right. Now to make those chains, the cost is given. This is the cost for making chains, right? Direct material, this is per unit cost. For total is this times 10,000 is 40,000. For material, for direct labor, it's a variable 2 times 10,000. Variable 1.5 times. Variable manufacturing overhead is this one. Now inspection, setup and material is 2,000. Machine lease is 3,000. Allocated fixed plant, administration, taxes and insurance is 30,000. So this is the total cost. These are the total. These are the variable cost, and then these are other costs, right? So 110,000 is the cost, right? Now if I look at here, what is the cost? 110,000, right? If I divide by 10,000, so it is 11, right? If currently if we produce it, those chains by our own, it's going to cost us 11 for one chain, let's see what else we have in the question. Ace has received an offer from an outside vendor to supply any number of chains Ace requires at 8.20 per chain. So when we look at here, we say, okay, it's going to cost us 11 and the cost is 8.20 from outside supplier. It is better to purchase from outside, right? If this is the scenario, let's see. Now, some other information. Inspection, setup and material handling cost, this number, this 2000, right? They basically vary. It's not a fixed, they vary with the batches, means in the groups, right? Ace produces chain in batch sizes of 1000 units. As Ace estimate that it will produce the 10,000 units in 10 batches. So now what is the cost? This one is 2000 divided by 10. So it is a per batch cost. What is the per batch cost? Right? It is this one, 2000 divided by how many batches? 10, means in 10 batches. So what is the cost? This is a 200 per batch. This is the cost. So this is not a cost for each unit. Basically this is per batch. So it is 200 per batch. Machine lease, what is the information for machine lease? Are payments Ace make for renting the equipment used in making chains. This machine lease is a cost only when we make these chains by our own. Why? Because we rent some machine, ijar. We need a special machine which we rented from outside to make these chains. If we don't make the chains, this cost will not be there. It is a fixed cost, but it depends, right? Remember, if we don't make these chains, the same fixed cost will disappear as compared to this cost, right? This is, if you see here, now assume if Ace purchases the chain from the outside supplier, right? Part A. If the facility where the chains are currently made will remain idle, should Ace accept outside supplier offer at the anticipated production and sales volume of 10,000 units? So should they accept this offer at 8.20 per chain? If you see it here, we should say, okay, it's cheap. But we have to see those fixed costs as well and see. Now again, we will see what are the relevant costs in decision making, right? So this is what we are looking at it, right? Those future costs and relevant costs, right? Let's see. Now, this is the given information. I just write it down, right? Now, the same table is given here, 8.3, right? This is all the given information in a question. So as I said before, 110 divided by 10, it's 11. So we'll say, okay, let's go for it. Is it a right decision only looking at it that it cost us 11 and outside it is giving 8 without considering the fixed cost? Let's see, we recalculate the cost and see how it's going to appear. Right, this is the cost for batch. This is the lease cost if we buy it from outside. There is no lease cost if we don't, if we buy this one from outside. Now this is the offer we receive from outside. Right, so same number, I just wrote it down here. Right, this is machine cost. So this is the cost, right? Now if we make it, this is the cost. 11 is the cost, right? 110,000 divided by 10,000 units, so it's 11. What if we buy it from outside? What will be the cost? Do we have to buy a material? What will be the material cost if we buy from outside? How much it will be? This will be 0 because it's a variable cost, right? Now see, this is 0. This is 0 because we are not spending. Variable cost will be gone here. Inspection and setup, this one will not be here as well because also it was a fixed cost based on if you make it, right? Now what is the cost to purchase from outside? It is 8.2 times 10,000, 82,000, right? 8.2 is the offer, and multiply by 10,000 you get 82,000, right? And there is no machine lease because you don't have to take a machine. So only thing is this is the fixed cost. So now what will be our costs now? So this and this only. So if you add these two, so if we continue to buy, we will pay this much. So our cost basically is 11.20, not this number. Very important. So what is a per unit cost is not 11. It should be 11.2 because this fixed cost is there. These costs will be gone, but this cost will be there. It is an allocated fixed cost for plant, administration, taxes, some insurance cost, right? It is there. You cannot avoid this cost. So it is 11.20 is the cost, right? So of course, if this is the information, what should be, whether we should make or buy decision. Should we buy from outside? What is your suggestion? If we buy, it is cost is high. It's better to continue making our own because it costs less. If we have to make our decision solely based on numbers without considering some other qualitative factors, only the numbers, then in this case we should not buy from outside because it costs us more, because our unit cost is more, right? So we should not accept the offer, right? Because it costs more when we buy. Let's say, see what is in the part B of a same question. For this question, assume that if the chains are purchased outside, facilities where the chains are currently made will be used to upgrade the bicycles by adding mud flap and reflector bars. Now, what they are saying here, that if we purchase a chain from outside, right, we don't make those chains, which is a one part used in a bicycle. Now, instead, we can use that open space to improve the product by adding mud flap and reflector bars, right? If we can improve our product, as a result of this improvement, as a consequence, selling price can be increased by 20 because our product is improved. And variable per unit cost of the upgrade, this is the additional variable cost, is 18. Additional total cost of 16,000 would be incurred, right? Should ACE make or buy the chain assuming 10,000 units are produced and sold? Now this is another scenario. Remember, this is decision making. Someone suggested that, okay, if we purchase from outside, we can use that open space or vacant area to improve the product. Now in that case, again, with this additional information, should we accept the offer or not? So again, we will see and calculate the costs. This is our existing scenario, right? Okay, so these are all the number given before, everything is same. This is the additional information here is the profit by upgrading the bike. If we make it, of course, we cannot upgrade the bike here, we cannot make any profit. But if we buy it from outside, of course, these variable costs will be gone, similar to previous part. So what is the cost to purchase chain is 8.2 times 10,000. Cost to upgrade the bike. What is the cost to upgrade the bike? It was variable cost was 18. If you remember the question here, I'll just go back. This one 18. Variable per unit, this is the additional cost, which is 18 times 10,000 is 180,000, right? This is the fixed cost remains there. Fixed cost of upgrade is 16,000 as well, it is given here. This one, additional fixed cost 16,000, this one here, this one 16,000. And what is the profit? If we increase, it is 200,000, 20 times, because this is the sales, right? you can increase the sales price by 20. So this is the additional profit you can get it. 20 times 10,000 is 200,000 is the additional profit. So what is our cost? This is our additional profit minus these costs, right? Let's see what are the costs, right? These are the fixed cost, these are the variable cost. So 200 minus all these numbers, it will get 108,000. So our total cost will be 108,000 if we buy from outside, right? This is if you make from, continue to make, this is our option. So now what we should do, whether we should make or buy, we can see from here. If you buy from outside, our cost is less, so it's better to buy it. Now our decision has changed from the previous part, right? Accept the offer because it cost us less when we buy the chain. Part C, next one. Now in part C is similar, right? Shall I go back and show you what is in part C? Sorry. Anyhow, so you can see in the book part C is that the sales manager is concerned. Just a minute, I will. Just coming back to part C. Actually, this is a part C. The sales manager, I'll just reading. At H is concerned that the estimate of 10,000 units may be high and believe that only 6,200 units will be sold. So the managers think that what we have used in the original table, 10,000 is a very high number, and we can only sell and produce 6,200 units. So with the production cutback means you cannot produce and sell 10,000, you have to produce less. So we have a more space now left, right? And there is room to add the mud flap and reflectors. Now we are producing less, we have a space where we can improve our product, right? Now at this lower output, ACE will produce the chains in 8 batches. Before there were 10 batches. Now they will be producing in 8 batches, right? 775 times 8, right? So if you, so this is basically 775 times 8 is 6,200. So basically in 8 batches we will produce 8 batches. So what was the cost of one batch? It was, if you remember, 200 was the cost of per batch, right? Okay. Now coming back to part C. So what is the direct material cost? We know what is the direct material cost. It was now what will be the direct material? 4 multiplied by 6,200. Remember this is given, right? If you, this one 4, before it was 10,000 units. Now 4 multiplied by 6,200 units. 4 times 6,200 is the material cost. 2 times 6,200, 1.5 times 6,200 in this part C. Right, so these numbers are changed because number of units has been changed. This is for inspection setup, 8 batches, 200 is the cost of one batch, 200 times 8, 1,600. Right, this is fixed cost, which is machine lease, this is same. So now if we, so what is the cost now? 81,100. This is for 6,200 units. 81,100 divided by 6,200, you get a unit cost of 13.08 if we make it by ourselves, right? And if we buy it, let's see what will happen. We will not get we will not pay for these costs, right? You can see here no material no labor, no variable cost. We don't have to incur our inspection cost because we are producing it from outside. Cost to purchase is 6,200 times the offer price, which was 2.20, right? I'll show you, right? So how we get these numbers, right? So this one is clear, only it is 8.2 multiplied by 6,200, 50,840. This is the cost to purchase from outside, no machine lease. This fixed cost you have to pay, right? So now what is the cost now? These are our cost, 80,840. Now if you want to buy it from, this is the cost. If you make it, this is the cost. Again, here we are going to decide solely based on this number, although there is a small difference, but still this cost us less. So we should accept the offer because it costs less when we buy the product. Okay, so this is end of this question. Now next question is similar to this one. Already I put a solution. You need to solve it by yourself and understand. It's very important chapter, right? This one is a long question similar to what we have solved in part A. This is part B. Both questions are similar, exactly similar, only difference in some numbers. So that's it. I'm going to stop here. So next topic will be for budgeting, which we will consider in the next class. Again, long chapter, practice, practice and practice. We might have quizzes, not might, we will have quizzes, because final exam is replaced by these online quizzes. So you'll have a quiz from chapter number 8. Again we will have one more quiz from this chapter. So this is a very important chapter. I keep on saying again and again. So quiz will be from this chapter. Practice, very important. Solve this question and practice. So that's it. I'll continue in the next class with the budgeting, which we'll see it in later slides. So wish you best of luck. So if you need any thing not clear, you can send me WhatsApp messages or you can send me an email. Thank you very much and have a good day.